all together in one room, which is always exciting. And it's a new year with new opportunities and new challenges. So that's exciting as well. We are kicking off 2026 with a positive economic backdrop, although there are still some questions about jobs and inflation. And as of late, there are also some new geopolitical questions, of course. Also, the S&P 500 just wrapped another impressive year with a 16% gain, driven largely by solid earnings growth. It marks the third year in a row of the S&P delivering well above its long-term average return. And as we prepare to look ahead today, we are also going to try to unpack many things for you today, including the evolution of the AI trade, what new Fed leadership could mean for the markets, and how a pro-business policy agenda could support further corporate profits. So there are a lot of dynamics to talk about today, but I can think of no one else to help us make sense of it all than the three guests alongside me today. So excited to welcome first and foremost Jurrien Timmer. Of course, he is Fidelity's Director of Global Macro and our unofficial quarterback, as we like to call him here on Marketsense. He's going to be talking about the outlook for stocks, bonds, and even alts in 2026. Also, we're thrilled to be joined today by Denise Chisholm. She's Fidelity's Director of Quantitative Market Strategy, and she's going to be talking about her research that focuses on historical trends to help inform future opportunities and risks as well. And, of course, last but not least, we've got Naveen Malwa with us today. He's a CFA charter holder and an institutional portfolio manager here at Fidelity for the strategic advisors team here at Fidelity, whose team manages millions of clients' accounts. And Naveen's going to be talking about how he and his team manage portfolios in this environment. So thank you to the three of you for making the time today. I know the beginning of the year is always a busy time of year for everybody, but especially for you. Jurrien, it's a pleasure to see you.
It's great to see you all in the flesh.
Yes, it's great to be back. Happy New Year.
Yes, Happy New Year. Let's get going.
Yes, Happy New Year. Let's do this. I'm really excited to dig in with the three of you. And we're only a few days into 2026, but already we have plenty to talk about as usual, right? We had this major geopolitical event in Venezuela over the weekend, Jurrien. Some investors may be, wondering what this might mean now for the markets, specifically for the global oil markets. How heavily should investors weigh these developments and talk about it from a market perspective, if you could, please.
Yes. So, these geopolitical events, the main question always is for investors is it systemically important for the markets? Will it affect earnings growth? Will it affect interest rates? Will it affect, sentiment, valuations? And I think this particular story, and the markets are already telling us this, is not really considered a systemic event for the U.S. markets. But the question, of course, is what does it mean for the total geopolitical world order? Will some other countries view this as an opportunity to do similar things? China, Russia come to mind. And will that sort of accelerate this new multipolar world order that we seem to be in? And, that can have long-term consequences, of course. But right now, at this moment, for the markets, it's not considered to be a market-moving event.
Okay. I know it's something that you are all certainly watching closely. I'm sure we'll be talking about this year. But let's take a step back for a moment and talk about 2025 and reset for a moment and just reflect on how we ended up where we are right now. So 1 year ago, we were all together, all of us in this room for the 2025 outlook, and the new Trump administration hadn't even taken office yet. We were preparing for them to come in. And think about it. 1 year ago today, how much uncertainty there was in the markets at that time, and how much that uncertainty really did carry on to be the theme for some of 2025. And yet, despite all that noise, the markets were pretty resilient. And it ended up actually being a very strong year for investors, which maybe in January we might not have expected. What do you think the drivers were behind that strength that we saw, Jurrien?
So I would describe 2025 as a year of many plot twists. And at the beginning of the year, I think the markets were pricing in what we would call a right tail outcome. So price for success, if you will. And initially that was the correct approach. And then, of course, the whole tariff thing started to unfold. And, everyone knew tariffs could be an issue after the election, but I think a lot of investors were kind of just keeping their fingers crossed that it was more bluff than anything else. But then it really came, and the markets had to price for what we call a left tail, like an adverse outcome. Earnings estimates were slashed. We were starting to worry about trade wars and capital wars and things like that. The market fell 21%, which is pretty significant. But then the tariff, threat receded, and the markets came roaring back. The AI theme kind of took over. The One Big Beautiful Bill Act started to dominate, and earnings started to really accelerate. And 2025 became a year of very solid earnings growth, allowing the valuation side of this bull market cycle to take a back seat. And so I think for 2025, that was really the main takeaway. And of course, the other one, from my perspective, was that interest rates took a back seat, right? The Fed eased a couple of times, and bond yields have been very, very quiet, much quieter than I expected. But so there were some benign backdrops in that sense as well.
Well, to your point, Jurgen, earnings were one of the biggest drivers of the stock market's performance in 2025. So, Denise, I wanted to ask you about that and what you think, what you anticipate the biggest drivers may be in 2026, and if that indicates that we might have another strong year ahead.
Yeah, I think in some ways, when you look at history, the 2025 drivers, I think, will help us into 2026 as well. So Jurgen mentioned the tax cut, which is, I think, underestimated still. It's about a 7% cut in the effective tax rate to corporate America. When you look at tax cuts, historically speaking, you do see earnings growth in the year that they're enacted, but you also see a bounce in corporate confidence that we have actually seen that makes that earnings growth durable into the following year as well. So if history is a guide, the bolstering effect that we saw in 2025 might continue to 2026. That's on top of the fact that we already had a CapEx recovery. Now, it sort of depends on the way you define it, but if you look at like the entire broad, S&P 500, and you add up all the CapEx dollars, how corporate America spends on stuff, and you normalize it relative to their sales base, you'll see that we've been in an uptrend since 2022. Given this tax cut, it does seem likely that that will continue into 2026. And that's good news because when you study history, CapEx cycles like that are very strongly correlated with durable earnings growth. And when I look at the data, we have it broken down by sector and industry. It's not just technology. 6 out of the 10 GIC sectors historically are in this CapEx recovery, where CapEx, the companies in that genre, are spending more than their normalized sales base since for the last 3 years. So I think that continuation of CapEx recovery continues the cycle of durable earnings growth into 2026. And I don't think the valuation is extreme enough to be potentially offsetting that, which gives you another good year of market returns.
Really strong signs, Denise. Good signals there. We have seen some cooling in the labor market, though, Naveen, and I wanted to ask you about that. How much of a concern could that be in 2026?
It's something my team and I are watching very closely. So we had a very strong year for the stock market. We had a growing economy, and yet many consumers are feeling stressed out. Consumer sentiment, it's low. I think a key driver of that has been this softening job market. So last year, we gradually saw the unemployment rise over the course of the year. It reached about 4.6% by the end of the year. It started around 4% at the start of the year. So that's an increase. But to put it into some context, a longer term, you go back to 1950, unemployment has averaged about 5.5%. So we're still at a very nice job market level right now. And in a recession, unemployment has touched closer to 6%. So we're not close to recession levels.
Okay.
Yet, jobs are such a key driver for the U.S. economy because consumer spending represents about 70% of our growth year to year if you look at the GDP numbers. So as long as people are employed, even if they don't feel good about the economy, they'll probably spend money, and that can support further growth. So that's the backdrop. Where we go from here, I'm going to lean into what Denise was just talking about. She mentioned CapEx. So what is CapEx? CapEx is spending on land, on factories, on software, new things that can help your business grow. Well, to set that stuff up, you'd normally need people to come in and help put those things together. And once you have
not computers,
land and factories and computers and software, you need people to come and actually use those things. So this could lead to actually better job outlook for this year based on what these companies are seeing. And it goes back to the tax reform Denise touched on. The tax reform is going to put more dollars in the pockets of consumers, of many businesses, and that could all be a nice tailwind for perhaps a job recovery. So what I'm hoping to see this year is at least a stabilization, right? If the unemployment rate stops going up, that's probably pretty good news for the economy and the job market, obviously. But if it starts to actually lead to more job growth, that's even more positive outcome. So we'll have to wait and see how it plays out. But there are factors in play here that indicate maybe we're heading in that direction. And just as a reflection of that, there is a survey of small businesses that comes out once in a while asking them, are they planning to hire more? And over the last few months, that survey has been ticking higher. So hopefully that carries through into 2026.
Okay. Let's talk about tariffs as well. Speaking of headwinds, tailwinds, so the Supreme Court is deliberating the legalities of tariffs, and we've just learned that they are later this week going to start those deliberations of, whether they exceeded presidential authority. So we don't know what the outcome of that is going to be at this point, but it seems the uncertainty that had been surrounding tariffs that you were talking about, Urian, in April has gradually receded or gradually did recede last year, leading to less market volatility. Do you see tariffs being a factor for the markets in 2026, Denise?
And we saw them absorb it in 2025. I mean, I think that was the interesting thing about the market and the offsets, the tailwinds versus the headwinds. I think everybody was focused on the headwind of tariffs, but when you added up all the dollars at the end of the day, as much as I think it's netting out to like 12% tariffs where we are right now, as much as that's very unique relative to history, if you added up just like a tax, it wasn't enough of a hit to the U.S. consumer to drive consumption negative. So it wasn't a recessionary hit. And what you saw is, despite the fact that nobody likes to pay more for goods and services, it wasn't enough to be recessionary at the time when the market discounted a recession. So, and at the end of the day, given legislation, given lower interest rates, and given, in some ways, lower energy prices, there were a whole lot of offsets for the consumer. So what we saw even in 2025 was that the consumer and the market absorbed tariffs. As we roll through into 2026, we might actually be lapping some of those tariffs, which make it possible that, we see the deceleration of inflation pick back up, which allows the Federal Reserve to continue to renormalize rates because they can, not because they have to.
Yep.
So again, you've got multiple tailwinds for the market.
Okay. So tariffs, is something you're watching, but it seems like that the concerns that we were thinking about when they were first announced in April have been assuaged a little bit.
Right.
Okay. Let's switch gears from going to the economy now to talking about stocks for a little bit and talk about this bull market, because this is, what we were saying, this is really one of the biggest stories of 2025. It's over 3 years old. And depending on who you talk to, of course, the average length of a bull market is 3 years. We've seen this market continue to reach new all-time highs. So first of all, what's going on with this market? Is it just bucking all the trends? And with valuations already so high, I guess, Urian, I'll pose this to you. How much more room do you think this bull market has to run?
So yes, the bull market started October of 2022. The S&P is up around 100% since then, which is a nice gain in the 3+ years. The first year or two were driven entirely by valuation expansion. And of course, the Magnificent Seven was very much a part of that. But in 2024, earnings really picked up and they grew about 11%. And in 2025, they've grown another 12%. And so the good part about this bull cycle is that earnings are really carrying their weight, and it's not just about multiple expansion. And so if those earnings continue to grow, as Denise indicated, it suggests that as long as there is not a lot of headwinds from interest rates or other things, that the bull market can continue. And again, that 3-year average that you mentioned, back in the old days, you would have a 4-year cycle when the economy was more industrially based. And so you would go up for 3 and you go down for 1. Over time, that trend has been elongated. And when you have a more favorable secular context, we've been in a multi-decade upswing now, the bear markets tend to be very short. They're swift but short, and the bull markets get longer. And that's what we've seen, right? That drawdown in April lasted, was it five weeks or so. Even the COVID decline of 35% was only 6 weeks. So they're very short and punchy, and then the bull market resumes. So my sense is that the bull market is intact. We're at pretty close to all-time highs. The participation is not as great as I would like to see. It is still...
Meaning the market's not as broad as you would like to see?
Yes, about 67% of the stocks in the S&P are in uptrends, which is better than nothing, of course. But my sense is that we're now in year 4, and earnings are carrying the day, and that's what we need to see.
Let's talk about that participation, as you put it. After 3 straight years of double-digit gains, I think it's just hard for investors to just keep wondering, when is this going to end? Was this euphoria going to end? And all the hype around the AI that's starting to look like a bubble to some investors, I think, is weighing on investors' minds. So what are your thoughts on concerns that AI enthusiasm may be overdone? And that question that we keep hearing, are we in an AI bubble? What do you think, Arian?
And by the way, in 2000, because when you think about AI bubble, many people think about the internet bubble.
The dot-com.
In 2000 was, or 1999 was the 5th year in a row that the S&P rose at least 20%. And that's never been done since or before. And so we're not anywhere close to that. But, 3 months ago, 6 months ago, I was worried. A lot of people were wondering whether the AI boom would turn into a bubble, and you start to see really punchy action in kind of what I would call the cats and dogs of the markets, non-profitable tech companies and meme stocks and things like that. And certainly we were starting to wonder, is this going to turn into a bubble? And as exciting as bubbles can be, they always end badly. So we'd rather not have a bubble and just a boom. Since that time, I think actually the likelihood of, first of all, I don't think we're in a bubble at all.
Okay.
Second of all, I think the likelihood of becoming a bubble is actually now greatly diminished in my personal view. And the reason for that is that all of a sudden, the scrutiny that maybe was lacking 3 months ago is now coming back. People are really starting to ask questions about the circularity of vendor financing, and is it sort of like a zero-sum game where some of the Mag 7 are competing for dominance against the other and they can't all win, and is there going to be too much investment in infrastructure and data center, and what is going to be the return on those investments? And so it's good to see investors asking those questions, because during a bubble, nobody asks questions like that. They just are
they're just sort of drunk. All right, so you don't think we're in an AI bubble, and the likelihood that we are has greatly diminished.
Yes.
You said greatly diminished. Okay, Denise, what do you think? Do you think that these concerns over valuations are justified, or do you think there's still room to grow?
Yeah, tech is expensive, no doubt about that. We have the data going back to the 60s. I'll define expensive as top quartile. I think we're trading as a sector around 30 times earnings, a far cry from, I think, 70 plus times earnings during the bubble. So that would be, data point number 1, that no, it's not a bubble. But I think the interesting part is you say, okay, so technology is expensive. Does that mean you have a higher likelihood of underperformance, meaning that it's not going to be as good as the rest of the market, or that it's likely not to be market leadership in 2026? And what you can see is for the last 20 years, when operating margins have been an uptrend, meaning that the companies have been more and more profitable, which has been the secular trend, and we're talking about all the tailwinds to suggest that will continue, what you actually find is the stocks have higher probability of outperformance the next year when their starting point is expensive versus when it's cheap. So it's one of those situations where it might not mean what you actually think it means. It's almost like valuation is just telling you, hey, investor, earnings growth is very, very visible. So yes, you might not get a ton of multiple expansion because you're already at top quartile levels, but that visible earnings growth still powers outperformance relative to the market. So for me, technology still looks like leadership because the fundamentals are still so strong.
So you're bullish on tech still. What else do you like for 2026? What other opportunities do you see out there?
Yeah, I've talked about this before, and I think I might have even talked about it last year, which is financials.
Still like financials.
Still like financials. And I think it's really interesting when you look at it. So when you look at valuation of financials, and you can sort of look at it back to the 60s, what you can see is that there's been a consistent higher odds of outperformance the cheaper they've gotten. And that's been true in every 5-year period, even since the financial crisis. So as much as it seems like, oh, it's got to be different this time, that valuation threshold has really limited your downside. We are now, as we enter 2026, back down to bottom decile levels. Now, what you see is over the last 5 years, the stocks they've outperformed 3 of those last 5 years. Financials didn't outperform last year, but over the last 5 years, they've actually outperformed in its entirety by about 200 basis points. So look, not a lot. It's not like you would say you had to own financials, but there also was limited downside as well. So there are sort of two ways to look at it, being like, it was sort of dead money, just a market performer, or maybe it was that valuation threshold was limited downside. So every time you see that bottom decile valuation, you kind of have a call option on maybe something goes right for the sector. So I do think that financials, interestingly enough, as we enter 2025, same thing as we enter 2026. I think that that valuation support is likely to hold, giving you, hey, we don't know what the catalyst might be, but be open-minded. If something goes right, you might have more upside there than you think.
Okay. We do have to talk about risks, too. So, Yuri, I'll let you be the bearer of bad news here. No, not bad news, so to speak. But, what should investors have in the back of their minds? What should they be keeping an eye on this year? We talked about geopolitics. We talked about AI concentration risk. What's on your radar?
Yeah, to me, and by saying this, I don't mean to indicate that they are likely to happen.
Right.
But when I think about what could go wrong, one is, obviously economically the cycle, but I don't really think there's a lot of indication of that. Earnings estimates are increasing, so there's momentum there economically. Certainly from a policy point of view, it seems like run it hot is like a strategy for the next few years. So I'm not so much worried about an economic contraction or a recession. But two things I worry about are our concentration risk, right? 7 stocks are at least a third of the market. They've amplified the return fairly greatly. And history suggests that if the top, let's say 50 stocks, if they're highly concentrated as they are now, if they go down, the index is going to go down, even if the majority of the stocks in the index are going up, because the S&P is a cap-weighted index. And so you could be in a fine economy, but if just a handful of multi-trillion-dollar stocks decide to go down, you're not going to get a lot for it. And we call that market beta, so the market return. And I'm sure, Naveen will talk about this. There are ways of mitigating those risks with diversification, et cetera. But that's one thing I worried about, that we've kind of front-loaded a lot of returns because of this concentration, and that it's been a tailwind, but tailwinds don't always remain tailwinds. So that's one thing. The other one is interest rate risk, not from the Fed, because the Fed has become more dovish and is likely to become even more dovish if the change of leadership happens the way the market thinks it will. But what happens to the back end of the yield curve, so long-term rates, right? So if the Fed were to lean too dovish, or the Fed, and we'll talk about this in a moment, gets sort of fragmented, or the economy runs so hot that inflation starts to reaccelerate, then long rates could rise relative to short rates. And right now, long rates are about 4.15%, very, very benign, nothing to see here type of thing. But history shows, the last few years shows, that when yields go to 4.5 on their way to 5, stock markets really starts to pay attention, because the risk-free asset, treasuries, are competitive with stocks now, right? They have about the same yield. And so if the yield on the safe asset goes up above the yield of the risky asset needs to pay attention and reprice. And so that is another risk. Again, I'm not saying it's imminent, but that is something we've seen play out over the last few years occasionally. And those are the two things that kind of give me some caution about, getting too far over our skis, if you will.
Too far over the skis, something to keep an eye on. Hey, Naveen, how do you and your colleagues think about diversifying against concentration risk, like Urian teed you up there?
There's different kinds of risks. There's concentration risk, the fact that such a big part of the market is the hand of these 7 stocks. That's one part of it. The other is, like Urian's outlining, these big picture risks that can affect the broader market. So I'll approach it a couple of ways. One is, at the highest level, how much of your investment dollars do you want to have in the stock market? The rest you can keep in the bond market or short investments. That's probably the baseline way of diversifying away from the risk at the highest level. That's one thing to keep in mind. But beyond that, a lot of people want to know, well, within my stocks, what could I do? So here's a lot of things we can do as investors. One, look beyond the technology stocks. Probably the most obvious thing to say. But Denise mentioned financials as an idea she's excited about next year, right? There's other opportunities out there beyond just technology. Looking at the global market, technology stocks had a great run last year, but looking overseas in developed markets like Europe and Canada, we saw utilities, we saw financials do really well last year, we saw materials do really well in emerging markets last year, which brings me to my second point is don't just focus on the US. You can look abroad, and last year, international stocks, after a couple of quiet years, outpaced US stocks by more than 15%, looking at the major indices for developed and emerging markets versus the S&P 500. So if that trend could continue, that might help these investors balance the risk, not just of those core 7 stocks or US stocks, but also bringing in the global marketplace to help balance some of those potential drivers of returns or potential drivers of volatility.
And for what you're seeing, does it seem like international stocks are poised to outperform US again?
Potentially, yes. We can get to that in a minute. The last thing I want to mention in the diversification story, though, is considering beyond just those traditional investment classes, thinking about things like commodities, real estate stocks. Those can be instruments or investments that can do well in a growth economy, and they can help buffer against inflation as well. And finally, alternatives. These are strategies that are becoming more accessible to investors that can help mitigate risk. They invest in a whole different set of ways. Like they can invest in areas like commodities or rising and falling interest rates. And that can be a nice way of diversifying away from stock market risk as well. Now, on the international
Yes, sorry, I interrupted your train of thought.
Not at all.
There. Yeah.
So, international stocks, tremendous year last year. Some of the drivers behind that, they had a good recovery economically and earnings-wise versus a couple of quiet years. And they were relatively cheap coming into this year as well. So our team actually was leaning more towards international stocks versus US stocks for the better part of the last 5 or 6 quarters. That paid off very nicely for our investors. And in spite of the strong performance they had, the valuations are still very attractive. And they also still have good outlooks for the earnings and economy like we do here in the US. That is a trend that could absolutely continue in international stocks. In international, people sometimes conflate the country headline, right? Well, there's tariffs happening. That must be bad for international. Or I saw something happening in Europe. That must be bad for European stocks. It turns out the markets don't always tie back to those political headlines nearly as much. Just as one example, the major markets in Europe, France, UK, Germany, they all performed extremely well and much better than the US stocks despite some of the challenges they ran into. In emerging markets, countries like Brazil, South Korea, that were in all these tariff headlines, had tremendous returns last year. So I think it's important to separate the fundamentals of those individual markets away from some of the headlines that are out there and not just assume that there's bad international headlines. That must mean bad things for international stocks. Oftentimes, over the long run, they can both play very nicely together, both US and international, and lead to a smoother return for investors over time.
I think that's an important nuance, or maybe just an important, theme to think about. That just because you see bad news in one country doesn't mean that that's not a country you might want to invest stocks in or invest in their stocks. All right, let's switch gears now. And you had talked about the Fed earlier, Yuri, and talked about bonds, and we'd like to talk about that with you in a moment, Naveen. But